Have you wondered what a weekend getaway in a treehouse would be like? Maybe you've desired to live like the old woman in a shoe. Perhaps you want the thrill of staying in a space pod from the safety of Earth. These exceptionally unique experiences are more and more common these days because of a business that likens themselves as disruptors in the hospitality industry. They have effectively democratized the hotel experience, and now anyone with a property can convert it into a mini hotel. That is the value proposition, at least, of this listing platform designed to connect property owners and travelers. I'm of course talking about Airbnb, a business that has completely changed the way we can experience travel. Welcome to The Quality Investor. San Francisco is notorious for its sky-high rents, and that was the case for Brian Chesky and Joe Gebbia when they moved to the city in 2007. Strapped for cash, yet observant of a certain need brought about a design conference in the city, the two noticed hotels in the area were selling out, but conference attendees needed to stay somewhere. Their loft had empty space, and they had extra air mattresses. Problem solved. For a fee, they offered lodging to conference goers by way of these air mattresses and prepared breakfast for them in the morning. An air mattress bed and breakfast. Airbnb was now in business. Today, I want to look at Airbnb as an investment and give an overview of why I believe it is undervalued. I will discuss the business model, the value proposition, risks, growth trajectory, and finally, what I believe the value of the business is. But before we get into it, please like this video and subscribe to the channel. It only takes a second, helps us grow, and you can stay on top of all the quality businesses in the market. Airbnb operates essentially as a broker. It matches people with space to rent, called hosts, to travelers or short-term renters, called guests. This model provides some advantages from an investor's standpoint. Airbnb collects a fee on every transaction. This is analogous to a toll in that there will always be space to rent and people to rent that space. The probability of this market drying up is near zero. Toll collectors generally have high streams of cash flow, and that leads to the next advantage in this model: margins. Airbnb does not own physical property. Physical property requires two things: upfront capital to acquire the property and ongoing costs to maintain the property. Airbnb's model has eliminated these cash outlays. This makes it an asset-light business, something that we covet on The Quality Investor, and increases operating margins. The cherry on top is that this fee revenue has almost no cost of service associated with it, giving Airbnb high operating leverage. That is, when revenue increases, associated costs generally stay flat or increase at a much lower rate than that revenue. Airbnb fancies itself as a lodging business, but has eliminated some of the highest costs associated with it. They don't have to pay staff to run the properties, and the hosts bear the maintenance costs and ownership costs, such as taxes. This creates excess cash that traditional hotel businesses cannot generate. Another way that Airbnb reduces costs is how their employees work. After COVID, the company switched to a remote work model. That reduced many lease operating costs they had for office space. There are over 5 million hosts on the Airbnb platform. These hosts operate their properties in over 220 countries and more than 100,000 cities and towns, a truly global platform. Airbnb is the matchmaker between these hosts and their guests. Its offer or value proposition for hosts is pretty straightforward. If you have a property or even extra space, you can monetize that easily and quickly. It provides hosts a user-friendly app that simplifies listings along with tools to set competitive pricing. Hosts also have access to a global audience. Anyone from anywhere can book your space. Hosts don't have to advertise traditionally. Hosts are also in total control. It's up to the host for when the space is available. Hosts set the rules of the space. There is a lot of flexibility there. Compare that to traditional lodging. It operates 24/7 as a going concern. But Airbnb also offers protection for hosts in the form of insurance. Up to $3 million in insurance is provided for a direct loss or damages to a property in the event the host and guest cannot resolve the dispute. And up to $1 million in insurance is provided for liability insurance for hosts should a guest suffer an injury or loss during their booking. Airbnb has also increased their guest verification processes to further build trust within the Airbnb network. How do the guests benefit from this platform? There is a vast array of unique and diverse options. Treehouses, pods, castles, villas, caves, glass cubes. If you can imagine it, it's probably available to rent. But this also gives a more intimate feeling to guests looking for a more local experience. Hotels tend to be in tourist hotspots, but many people want to experience the ambiance of local neighborhoods. Staying in a home or condo surrounded by locals is certainly an option. There are large accommodations for groups. I had a family reunion of sorts a few months ago outside of Cincinnati. Rather than staying in a hotel in different rooms, we were all in one house. It was quiet, but nice to have everyone in one place. Not to mention the privacy. We had a kitchen and play area for the children. There was a level of freedom there, just not available at hotels. And all of these options are available at various price points. Much has been made about the affordability of Airbnb, but the budget conscious can find what they are looking for with a little diligence. But once a group becomes larger than about 4 or 5 people, it really does become much more affordable than a hotel as group size increases. I ran the numbers on our Cincinnati stay versus a hotel option, and it was roughly 30% cheaper than equivalent hotel options in the area. And this accounted for cleaning fees and taxes. Splitting a bill 12 ways is quite digestible. This is also true for long-term arrangements, another area where Airbnb excels. Besides typical vacation accommodations, people that are relocating to a new city for a job or live a digital nomad lifestyle can find affordable long-term stays. Month-to-month leases for an apartment complex can be pricey, but Airbnb offers a solid alternative here. To be sure, every benefit I just mentioned for guests existed before Airbnb. What Airbnb did, however, was centralize all of these variables onto a single platform. It made the experience very easy to use. It provided tools for hosts to dynamically and competitively price their rentals. It also allowed for hosts to easily rent unused or underutilized space as a sort of a side hustle, and whenever or however a host wants. Running any sort of lodging business tended to be a full-time operation. While some hosts do that, the flexibility exists to just earn a little extra income. And over the years, this host-guest relationship has built a strong network effect. As the user base grows, so does the value of the platform. Hosts benefit from increased demand as more guests sign up, and guests benefit from more options as hosts sign up. There is also a trust that has been building within the network as reviews and ratings have become very comprehensive. Guests are now verified, and reputations within the network are important to maintain. This creates a better experience for host and guest. All of this is solidifying Airbnb as a top brand in the travel service industry and building a very loyal user base. Airbnb does face risks going forward. The biggest risk, in my view, comes from city councils via the hotel lobby. Large cities, such as New York and Chicago, have imposed strict limits on short-term rentals. I've linked Chicago's requirements below, but many of these were implemented after outcry from the local hotel industry or residents in various neighborhoods. There are some legitimate reasons for this, however. Some cities saw a large boom in short-term rentals, which altered the housing market. A study published by David Proserpio argued that Airbnb contributes about 1/5 of rental rate increases in the United States and about 1/7 of the United States housing price increases. So, if rents rise 5% in 1 year, 1% of that rise is attributable to Airbnb. I've linked the study in the description. There were also public safety concerns around large gatherings or even drug trafficking. In addition to cities imposing fines on hosts that rent out their properties for parties, Airbnb themselves banned parties in response. This has made the overall experience better, in my view. Some cities also impose limits on duration of stays and what type of property can be used for rentals. In New York, hosts must be present for rentals that are less than 30 days. In Chicago, one-night stays are banned. These are the local regulatory environments Airbnb must navigate. Some regulations, like banning parties, I think add value to the experience. However, there are real restrictions on Airbnb that can put downward pressure on revenue growth. But Airbnb does not derive more than 2% of its revenue from any one city, according to the annual report. And Airbnb has expressed that none of these regulations have had any material impact on operations. There is also risk from other competitors. Booking.com, for example, as well as Vrbo, which is owned by Expedia, create cross-platform listings for hosts. This can drive traffic away from Airbnb. So Airbnb must market itself effectively to keep that traffic on its platform. Vrbo has a host-free marketing promise to differentiate themselves from Airbnb. And many guests value privacy over all else. This limits their options in the market, however. In many cities, this means Vrbo can only offer long-term rentals or single-family homes. But I believe this caters more to the vacationer. In my experience, I've never had an Airbnb host present where I've stayed. And outside of urban areas, this really doesn't seem to be an issue. If you've experienced something different, however, please let me know in the comments below. Other risks, such as seasonality, as well as economic slowdown, or as we saw in 2020, global pandemic, can affect Airbnb. Competition is fierce in this space, which is normally a turnoff for me. This is because it is tough to maintain or grow return on invested capital in a crowded market. Businesses with monopolistic tendencies tend to perform better. But I believe Airbnb's growth in the experience segment, which is more traditionally the purview of Booking.com and Expedia, is a strong growth area for the business as it holds the network effect properties of the host-guest model. Given Airbnb's operating model and ability to generate free cash flow, I think over the long term, their cost structure will be superior to competitors. Anecdotally, I think Airbnb has the strongest brand of the travel services businesses. I know people who only use Airbnb, and I often hear Airbnb as the only alternative mentioned when comparing it to more traditional hotels. In my opinion, I believe Booking.com and Expedia have more to fear from Airbnb than Airbnb does from them. For any investment to be successful, the underlying business must continue to grow. So, I want to go over the growth Airbnb can expect. Some target demographics that Airbnb performs well in are remote workers, digital nomads, and temporary relocations. Airbnb has a more robust offering to these market cohorts. Vrbo positions itself to more family-oriented travelers and vacation-type homes. That is certainly not going away, but Airbnb provides this just as well or better than Vrbo. It is the growth in remote work where Airbnb has its competitive edge. Remote workers are looking for amenities that cater to remote work, as well as access to desirable locations such as urban cores. Many restrictions cities are imposing on hosts apply to short-term rentals, which are 30 days and under, but long-term rentals are unaffected. Airbnb is investing in this aspect of the market. According to the World Economic Forum, remote jobs will increase 25% by 2030 to over 90 million jobs that have remote work potential. In the United States, estimates put current remote jobs at 15% of total jobs, up from 4% pre-pandemic. Demand for remote work is increasing. Over 40% of job seekers want fully remote positions. This trend will accelerate, in my opinion. This is due to retirement of older bosses that tend to frown on remote work, businesses seeking to broaden its talent pool outside of a local area, and the perk itself becoming a selling point to attract workers to a position. Airbnb seeks to capitalize on these trends. There is massive white space available for remote workers and, by extension, remote work accommodations. Aside from the push to capture this market, Airbnb is moving into under-penetrated markets such as the Asia Pacific, Latin America, and Africa. Year to date, 45% of Airbnb's revenue comes from North America. That's a decrease from 46.6% from the same period last year. Latin America and Asia combined were 16.1% of revenue year to date, compared with 15.2% last year. These areas represent big growth opportunities. Airbnb is also scaling its experiences offerings. These are unique activities designed and led by locals, ranging from cooking classes and guided tours to adventure sports and cultural workshops. This launched in 2016 and now includes over 1,000 cities. Similar to rental bookings, Airbnb collects a fee for each experience booking. Airbnb is upselling its stays with these experiences to drive higher spending per booking. This also presents opportunities for Airbnb to partner and collaborate with brands as well as local artists, chefs, and other creators to offer premium and differentiated experiences. What Airbnb is attempting to do is to vertically integrate the travel experience. From booking to activities, Airbnb wants to have everything under their brand and take a cut of the money changing hands. Airbnb's long-term vision is to transform itself into a comprehensive platform for living, working, and traveling. By continuing to innovate, diversify, and adapt to changing consumer preferences, Airbnb aims to remain a leader in the sharing economy and become the future of hospitality. So, let's take a look at what the numbers say. Airbnb's IPO was towards the end of 2020, and since then, their performance in the market has left a little bit to be desired. They're currently trading at $130.95. Their 52-week high is $170.10. On a 3-year basis, they've returned negative 8% annually for investors, and on a 1-year basis, they're down 11%. And even year to date, they're down almost 4%. So this stock has not been performing well since its IPO. Airbnb did peak in late February of 2021 at just over $216. So since then, it's actually down about 40%. But that just means the stock is back at much more reasonable valuations, which are hopefully based in reality. And I think that they are. So if we look at their revenue, we can see a steady increase in revenue year over year every single year since their financials were first available in fiscal year of 2017. They're even up on a trailing 12 basis. Obviously, the COVID year is an exception, especially for the travel industry, but the company has been consistently growing its revenue, 22% per year on a 5-year basis and just 18% from 22 to 23. It's probably going to be up about 10% at the close of 2024. Gross profits are also up, increasing 20% on a 1-year basis and 24% annually on a 5-year basis. But this operating income number does look a little bit concerning. Not only that, the earnings per share from fiscal year 2023 to trailing 12 also looks concerning. So what's going on here? If we look at the 2023 annual report, we come down and we see the general and administrative expenses, that expense margin went from 11% in 2022 up to 20% in 2023. That's 900 basis points of an expense margin increase. But the description there tells a different story. It says that the $1.1 billion increase in general and administrative expenses for 2023 was primarily due to an increase of $991 million related to business and operational taxes, a majority of which is non-recurring. Okay, fair enough. We should expect that general and administrative expense margin come back down to what the 2022 level was. Sure enough, looking at the 10Q for Airbnb from its latest fiscal quarter, the end of 9/30/2024, we can see that through 9 months year to date, that general and administrative margin is back to 11%. In fact, it was down to 9% for just Q3 alone. So the first thing that shows us is that that big hit, that one-time non-recurring charge in 2023 was taken in Q4. But more importantly, we're seeing that Airbnb hasn't let their costs get out of control. Right now, the trailing 12 earnings per share is at $2.85. For all of fiscal year 2023, it was at $7.24. That's quite a drop. And in fiscal year 2022, it was at $2.79. So the first point is it's higher on a trailing 12 basis than it was in fiscal year 2022. But why was it so high in fiscal year 2023, especially when we saw an operating income fall in that same year? So coming over to page 97, note 14 of the 2023 annual report, we see why that earnings per share increased so much during that year. It is due to this valuation allowance. So this is all boring accounting related tax stuff, which by the way, was my least favorite accounting class when I majored in accounting when I was at university. Essentially, they had a $3.2 billion gross deferred tax asset on their balance sheet in 2022. They also had $3.2 billion in 2023. But what they also had was what they call a contra account, or a valuation allowance of $3.16 billion against that gross deferred tax asset. Essentially, that valuation allowance is put there if the company believes it's not likely it's going to receive the benefit of that deferred tax asset. If you really want to learn about what deferred tax assets are, I recommend reading Warren Buffett and the Interpretation of Financial Statements. Warren Buffett gives a very simplified explanation as to what deferred tax assets are to people that don't have accounting backgrounds. The point is, in 2023, that valuation allowance is now $364 million. It came down by about $2.9 billion. What Airbnb is saying is that in fiscal year 2023, they now believe that they're going to get that benefit from the deferred tax assets. Therefore, they wrote off this valuation allowance. Writing off that valuation allowance is recognized as income on the income statement. And it goes in the non-operating section of the income statement, specifically where the line for tax expense goes. You can see that here on the income statement in 2023, a $2.69 billion provision for benefit from, because it's in parentheses, income taxes. So they take that income before income taxes, add in the $2.69 billion, and that's where we get $4.792 billion in net income and $7.24 earnings per share, a massive increase of $2.79. And why it looks like there's such a drop off on a trailing 12 basis here, down to $2.85. Essentially, there's a lot of one-time charges creating noise inside of the income statement for Airbnb. And as an investor, you have to understand how to remove these one-time hits to an income statement because they really don't affect ongoing operations. When you're investing in something, what you're investing in is the ongoing operations. Think of it as like you're buying something 100%. All you really care about is what is material to the operation of the business. All this one-time stuff that happened in the past doesn't affect the bottom line of the valuation in that way. So a lot of material that was more bearish on Airbnb cited this big drop in earnings per share. I highly doubt they actually read the annual reports here. Nonetheless, the stock just has not performed well since its IPO. But what we can see is a few things. They're profitable as of fiscal year 2022. So earnings per share was negative in fiscal year 2021. We kind of have to throw out 2020. That was the whole weird global pandemic. But then it's been profitable since then. But more importantly, they're starting to generate an increasing free cash flow. On a trailing 12 basis, it's already over $4 billion. At fiscal year 2023, it's at $3.9 billion. The free cash flow has gone up 50% annually. It's up 14% from fiscal year 2022 to 2023. And it's going to be up again at the end of 2024. Part of the big reason why they become free cash flow positive is what I talked about before with that cost structure. They're a very capital light business. They have actually no capital expenditure. They have capitalized software costs here and there, but it's not material enough to really put it here. But the point is, they're incredibly capital light. So almost all the cash they generate from operations is going right back to investors. So looking into the actual margins here on the expense side of the income statement, what is going on? Well, in the last 5 years, we can see that they've reduced their cost of goods sold margin down quite a bit. The margin is down to 17%. That was the operating leverage I was talking about earlier. It cost very little for Airbnb to add new hosts and new guests to their platform. A lot of actual operational costs involved in running a property, that's all handled on the host side. But what has gone up here? So we can see that the SG&A has actually sort of gone up a little bit, right? So in fiscal year 2022, SG&A margin was at 36%, and it's now at 46.25%. That trailing 12 number is flat from fiscal year 2023, 46.12%. But what's also gone up a little bit is the R&D. So R&D is at 20.96 in fiscal year 2023, and it's up over 60 basis points to 21.65%. Now, Airbnb is still a growing business. I would be more worried if I saw a large increase in general and administrative overhead than seeing a marketing campaign starting to target new cohorts in the market, which is what Airbnb is clearly doing. Personally, I've seen a lot more commercials on Airbnb in this last few months than I have anytime prior to 2023. And their product development, the R&D side here, this is increasing in my opinion because they're doing a lot of stuff, implementing new features to the Airbnb app, the platform, around AI, which the company is saying helps match hosts with guests, recommends more personalized experiences for guests, as well as helping hosts offer more dynamic, competitive pricing for their properties. To me, that's going to benefit Airbnb in the long run, even if it pushes operating margins down slightly year over year. So I'm not too concerned with these increased expenses that the more bearish people on Airbnb are saying. I think they're expenses that are pretty necessary to setting up Airbnb as a long-term player in the travel services industry. And here we can see what the actual margins have been doing since fiscal year 2021. I'm only looking back to fiscal year 2021 because any time before that, really not relevant from the investment standpoint, as it IPO'd in 2020 and there's just a lot of noise of the COVID year. Their operating margin, down slightly. Gross margins are increasing. But really what's important here is return on invested capital. They have a 73% return on invested capital, a 37% return on capital employed. Again, that speaks to how capital light this business is. They have to invest very little back into the business to drive new growth. This is very good for investors. This is what ultimately expands margins and compounds free cash flow. I've done extensive videos on the importance of return on invested capital before. And that free cash flow yield is looking pretty attractive at over 5% now. The way I project revenue for businesses is I just see what's driving that revenue growth from the annual statements, how they segment it out. And what Airbnb does is they look at night experiences on a total gross basis. So in 2023, 448.2 million nights and experiences booked. The gross booking value of those nights and experiences came to $73.25 billion in total gross booking value. And then the average booking value, which of course is gross booking value divided by nights and experiences, $163.40 for every night and experience booked. Airbnb takes a fee on top of all of that. And so the way I got that fee was by taking the total revenue, dividing that by the gross booking value. And that comes out to about 13.5% for 2023. And we can see over the last 6 years of data here, that fee is about 13.13%. Going forward, that's what I'm projecting here. So in year one, for example, I have a total revenue growth of 11%. It's driven by about 9.25% growth in nights and experiences booking. All of this is based on the outlook from Airbnb as well as a couple analysts. And then the gross booking value up about 11%, which gives us close to a 2% increase in average booking value to $166.30. I'm projecting the same fee. So ultimately, just over $11 billion in revenue for Airbnb in year one. So I'm projecting that Airbnb fee to increase at just under 1% at 0.75% per year, not 0.75 plus 13.5, but just a 0.75% increase of 13.5. So by year 10 in the valuation, their Airbnb fee would be about 14.5%. And I'm projecting nights and experiences to grow about 8% through year 10. And I'm expecting that average booking value to go up about 1% per year as well through year 10. So that ultimately gives us roughly 10% on the dot revenue growth for Airbnb over the next 10 years. I believe 10% revenue growth is fairly reasonable. On a 5-year basis, they've grown revenue 22% annually. I'm projecting less than half of that growth over the next 10 years. Operating margin, I'm expecting to be about 27% by year 10. Operating margin on a trailing 12 basis, it's at 15%. But remember, it still includes that big write-down from Q4 in 2023. That's going to come out by year one, a 25% operating margin. And then only growing to 27% by year 10. Not huge growth there. And free cash flow margin, by year 10, I'm estimating to be at 37%. Their fiscal year 2023 free cash flow margin, 39%. On a trailing 12 basis, 38%. I'm projecting 0.5% per year degrowth of free cash flow margin percent by year 10. Basically, flat margin growth for free cash flow. All of these very conservative estimates, in my opinion. Because remember, at the end of the day, what we're really valuing is how much cash a business spends off. That's free cash flow. And over the next 10 years, if their free cash flow margins stay at about 37%, we're looking at a discounted cash flow price of $221.05. That's a pretty nice increase from the current price of $130.95. Just to give you an idea of what my other assumptions are, operating margin for the bull assumption I have at 28%. Ultimately, my free cash flow conversion numbers, $1.60 for the bear case, $1.70 in the base case, and $1.80 on the bull case. That is, for every dollar of net income Airbnb generates, how much do they convert into free cash flow? For year one, I'm expecting about $1.88 there. Trailing 12 basis, it's at $2.24. The bull case, total revenue growth at 11.5% per year over the next 10 years. And ultimately, that free cash flow margin at 41% by year 10 in the bull case. They've hit that in a few one-off quarters here and there. So I'm not projecting any wild growth here. I believe Airbnb is a very well-established brand. I believe they're still in their growth phase. But right now, management has done a very good job of just steadily growing the business, focusing on the user experience over ultra-fast growth. And they've also shown themselves to do a very good job navigating some of those risks I mentioned earlier, especially in the regulatory environments. Airbnb is at $130.95 right now, with a trailing 12 earnings per share of $2.85. The fiscal year 2023 huge tax benefit they had really pushed down that PE ratio to below 20 at the end of fiscal year 2023. The PE ratio is at 45.9 now, since it is based on a more accurate reflection of earnings per share, which one could argue is a very high PE, but I still think that Airbnb's in its growth phase, like I mentioned. Our forward PE is at 38. The discounted cash flow I have on a bear case, and this is based on that 33% free cash flow margin, it's $181.31. You've already seen the $221.05 DCF for the base case and $270.13 for the bull case. The exit multiple valuation is $105.20. It's based on comps of Booking.com, Expedia, and TripAdvisor. So you can see it's actually bringing down the overall valuation of Airbnb because the average PE of those three businesses is 37, quite a bit below Airbnb's at 45.9, and more in line with their forward PE. Even on a bear case, I have an upside of 18%, 37.9% upside on the base case, and over 60% upside in the bull case. With no margin of safety, that's a buy price of $182.04 and a forward PE 52.8. But with a 20% margin of safety, we have a buy price here of $145.63 and a forward PE of 42.2. Personally, I just made a pretty large investment into Airbnb this week. I made it prior to Friday, so I didn't get to experience the big dip that they had on Friday, unfortunately. So my cost basis now is a little over $137, but I would be comfortable buying Airbnb up to about $145. It seems to be out of favor in the market right now, so we could see some more downward pressure on the price. It's likely I'm a little early on my investment, but as long as the company just keeps pumping out free cash flow, growing its revenue every year, and stays disciplined in its cost management, we have a very good future compounder on our hands here. Thank you for watching today's video, and if you've made it this far, go ahead and subscribe to the channel. Thank you, and happy investing.